If you've been watching my channel for a while, you must know that I like to trade options. I have a portfolio of options that I take care of. I have trades that are going to last several weeks or maybe several months, depending on the trade. Usually, I'm not necessarily a fan of day trading options. However, there is a type of trade that I like to take. It's every quarter that I like to take this type of trades, and I guess that it could count toward the day trading as it lasts less than 24 hours. And I wanted to share with you why is this type of trade that I like to take every quarter, what is the strategy that I use, so hopefully it's useful for you. Maybe if you want to do the same, it will bring you some insights on how I do it personally. And by the way, if you find this video interesting and you actually learn something while watching it and you find it cool or interesting, please consider subscribing to my channel and liking this video. It's really the best support you can give me and I'd really appreciate it. So this type of trades, if you have seen the title of this video, it must be pretty clear. It's about earnings. But before going into really the details of the trades that I like to take, what is the strategy that I like to follow, I really want to make sure that we are on the same page in terms of what are earnings, what is the philosophy behind the trades that I like to take, so we are on the same page, all of us. Earning announcements are when a company releases how much money they earned during the last fiscal quarter. And that's something that happens every quarter for all the publicly traded companies. They're going to say on an earning call, for example, how much money they earned during the last quarter, and usually you're going to have a lot of betting on this, meaning that analysts are going to try to forecast how much money they made, what is the earning per share. I mean, that's something that you're often going to find in reports where analysts try to forecast what is the earning per share, for example. However, analysts are not the only ones trying to speculate on earnings. There are a lot of people trying to guess the stock's direction when it comes to the earnings. And let me give you an example so it's completely clear. If you think that, for example, Apple had a great last fiscal quarter and you think that they're going to beat their predicted earnings, and then you think that the stock is going to go up, for example, then you're going to maybe buy a call so as to express your bullish view. That's something that a lot of people are going to do when they see that earnings are coming. They're going to buy either a call or a put, basically betting that the stock is going to go up or down, depending on what they think about the future earnings that they're going to release. But the reason why I want to talk about earnings, and especially why I want to talk about the fact that people are buying calls and puts so as to try to predict the stock movement, is that there's some really interesting phenomenon that happened because of that. You see, earnings have a direct impact on option prices, and that's something that you can really see by yourself, and you'll see that after I have some examples for you so as to show my point and prove my point so it makes sense for you. When earnings are getting closer, you're going to see that option prices overall, and I say as overall, they tend to become more and more expensive. And why is that? As the earning announcement is coming closer and closer, people are betting more and more that the stock is either going to go up or going to go down. So to express that view, they're going to either buy calls or puts depending if they think that the stock is going to go up or down. But what happens to a product when a lot of people are willing to pay for a product? Well, the price of that same product is going to increase. That's the law of supply and demand. There's nothing crazy about this, that's just supply and demand. Well, that's exactly the same with options. When you have a lot of people at once who are willing to buy a certain option, then the price of that option is going to increase because now more and more people are willing to buy it, and people are willing to pay more and more expensive prices to acquire that option because they see value in it. For example, if they think that the stock is going to go up, they're willing to buy a call, and as more and more people are willing to buy a call, then the call prices are going to go higher and higher because more and more people are willing to buy it and add more and more expensive prices. And the more and more people are willing to buy an option, the more expensive that option is going to become. And the opposite is true, by the way. If less and less people are willing to buy a certain option, then that same option is going to get cheaper and cheaper. Because there are less people willing to buy it, it makes sense that the price is going to get cheaper. And that's something that you can really see over and over again. Of course, I'm not saying that every stock tends to see their options increasing in price as the earning announcement approaches, but if you look at, for example, most of the stocks, you're going to see that it tends to get more expensive when it comes closer and closer to the earning announcement. And then comes something that is very famous. If you have been in the option trading world, you must have heard about it. That's called the IV crush. The IV crush refers to a sudden drop in option prices, and the IV crush means implied volatility crush. But what's the link between the implied volatility and the option prices? Well, the implied volatility is basically found because of the option prices. So if you see that the option prices are getting more and more expensive, you're going to see that the implied volatility is also going to go higher and higher, and vice versa. If option prices are getting cheaper and cheaper, then you're going to see that the implied volatility is going to go lower and lower. Option prices and the implied volatility are correlated. If one goes up, then the other one is going to go up, and vice versa. But why am I talking about this? Because when we talk about the implied volatility crush, we refer to a sudden drop in the option prices. And the moment where this IV crush happens is right after earning announcement. That's something that happens over and over. And what happens up to the earning announcement is that people are willing to buy more and more calls and puts because they want to express either the bearish or bullish view on that particular stock. And what happens when the earning announcement actually happens? Now that it happened, there is no point anymore in trying to buy a call or a put because now we have the answer. Did the stock go up or go down? So as less and less people are willing to buy those same options, the option prices are getting cheaper and cheaper. And usually what you see is that directly after the earning announcement, there is a sudden drop in the option prices. And as option prices are getting suddenly cheaper, you see that the implied volatility is suddenly getting lower too. That's why we call that IV crush, because you have literally a crush in the implied volatility, and I'm going to show you with examples just after so it makes sense, but you're going to see that it really drops suddenly. That's why we call that IV crush. That refers to sudden drop in the implied volatility, which is a proof of a sudden drop in the option prices. And I know that this is quite abstract when I just talk about it like this, so that's why I wanted to show you some examples on the computer so it makes really sense for you and you can visualize what is the IV crush and what is the impact of it. So right now I'm in the Thinkorswim platform. This is not necessarily the platform that I use. You see that I even have a demo account with them. I don't even have a real account. I usually use Testyworks. However, this is quite cool because on Thinkorswim you can visualize the implied volatility, which is really useful when we talk about IV crush, for example, because you can literally see if there is an IV crush happening or not because you can plot the implied volatility onto the chart. So I have the stock CVS in front of me and I wanted to show you the implied volatility crush visually. So you're going to see where is the implied volatility crush here. So what you see here obviously within that rectangle is the stock price, nothing crazy about this. When you see those dollars within those green bubbles, those are the dividends, and when you see those things that are in red within the red phone or the blue bulb, those are the earnings. So every time you see, for example, those blue bulbs and red phones with the small number above it, for example, $2.64, $1.66, and this one, those are the earning announcements. So this is when a company is releasing how much money they earn during the quarter. And for example, those green numbers, for example, $2.64, that refers to the earning per share. Remember that I talked about analysts who try to predict what is going to be the earning per share? Well, that's what it is. Like, that's the earning per share that you can see. And for example, you have another one here. And down below, you have the implied volatility. And with that, I'm going to show you how you can see the IV crush and what it actually looks like in real life. So let's focus on the last earnings that they had so you can see this IV crush that I was talking about. So if we, for example, zoom a bit more on CVS, you can see that this is where they had their earnings. Like, well, let me just put it within this yellow rectangle. So this is when they had their earnings. So you can see that the stock moved actually quite a lot during the last earnings. It opened higher, but then it came down. And if you look at the same time at the implied volatility, so let me put this within a rectangle so it's completely clear. You see that on the day of the earning announcement, you can see that the chart for the implied volatility went actually down. You see that the implied volatility went down the day of the earnings. So literally on the day of the earnings, you can see this implied volatility going down quite quickly. You see that it went from 0.38 to literally less than 0.30. So this is quite a big drop in the implied volatility, and this is what we refer to the IV crush. And this is the IV crush. This is really a good example of the IV crush. And what does that mean, that IV crush? Is that the moment the earning announcement got released and we learned about how much money they made and everything, we saw the implied volatility going down, proof of option prices getting cheaper. So what would you have seen in real time if you had looked at option prices? You would have seen that option prices suddenly got cheaper right after the earning announcement. That's the IV crush, and that happens most of the time. If we dezoom and we looked at all the different earnings, let me just put them into yellow rectangles so it's completely clear. If you look at the center every time of those yellow rectangles, you can see, for example, very well here, the IV crush also happening. You can see it happening again here. I mean, this is, and you can even see it happen once again here, a big one IV crush. You can see that for example CVS, it happens all the time. You always have this very sudden drop in the implied volatility, proof of a sudden drop in option prices. And now I've chosen the stock PayPal, so I've already put the yellow rectangles because now you start understanding what it is. And if we look, for example, at the implied volatility chart just down below, you can see that every time there are earnings, you can see that the implied volatility crush happens. I mean, you can see those big drops in the implied volatility all of the time. I mean, it's literally each and every single time that there is an earning, you can see, for example, for PayPal, that there has been an IV crush. And as I said, it's a proof that option prices are suddenly getting cheaper. And what is interesting to see is that you can see that there is literally the implied volatility rising up to the moment where there is the IV crush. So that's what I was talking about just earlier. I said that up to the earning announcement, you're going to see that option prices are getting more and more expensive. Up to the earning announcement, then you have this IV crush and option prices get very cheap once again. And you can see over and over, I mean, like literally every time, for example, for PayPal this year, you can see that the implied volatility is rising and then dropping suddenly. And that's exactly what earnings are doing on option prices. So what does that mean now that you understand what is the IV crush and visually what it actually is and what it actually means for option prices? What should you do with that? And by the way, if you have Thinkorswim installed on your desktop or your MacBook, you should try by yourself, try to see and try to spot those IV crush. Just take a random stock, look at when the earnings happen and put the implied volatility chart down below so you can compare at the same time the implied volatility and see by yourself what the IV crush is and if it happens, for example, for stocks that you're looking at. And you're going to see that most of the time you're going to see this big drop in the implied volatility, this IV crush happening directly after the earning announcement. So how can you take advantage of this? How can you take advantage of earning announcements? Well, that's when we come to talk about those high probability trades that is in the title of this video. You basically have two ways of trading earnings. Either you want to take the buyer side, meaning that you're going to buy options way before earnings and you're going to hope that the option prices are going to increase as the earnings announcements are getting closer and closer. However, the big drawback about this strategy is that you're going to be affected by the time decay. As you buy options, your options are going to lose value on a daily basis. So in my opinion, that's not necessarily the most optimal strategy when trading earnings. What I really like to do is taking the seller side. I'm going to sell options during earning announcements and I'm going to try to benefit from that IV crush. Because think about it, when you sell options, you hope for the option price to decrease. So if you have the IV crush making option prices decrease, then it's great because you made money like this. Because you want the option prices to decrease when you sell options. If you're in a trade while there is the IV crush happening, then the option prices are going to lose value, which is exactly what you want as an option seller. So how should you sell options? Well, the way I do it is that I like to sell short strangles. What are short strangles? Well, short strangles are selling a call and selling a put at the same time. And now you can see what is a short strangle in terms of P&L. So for those who don't know what this type of graph represents, so the horizontal line that you can see up here is the different strikes for the stock, meaning that, for example, if right now the stock ends up exactly in the middle at expiration, then you can see that I'm going to make my max profits. If it finishes, for example, down at a lower price, then I'm not going, for example, to make full profit if it ends up here. And if it goes out of my profit zone, then that's where I'm going to lose money. So when you sell a call and a put at the same time, you create a trade where you essentially bet that the stock price is going to stay within your strikes. For example, if you sell the 90 strike and the 150 strike, then you hope that the price is going to stay between $90 and $150 before expiration. And let me show you an example and test it works, because I know that with examples it makes a lot more sense. So right now I'm in the option chart for C, and without really going too far in the details, I just want to show you visually how it looks. If I sell a put, for example, at the 68 strike, and I'm going to sell a call at the 78 strike. If I go into the P&L graph, so you see that it looks a lot like what you just saw before with the profit zone and the red zone. If the stock stays between 67, my break even, and around 79 at expiration, then I'm going to make money. I'm going to make a profit. If it goes out of that profit zone, then that's where I'm going to lose money at expiration. And that's really the premise of the short strangle. You bet that the stock price is going to stay within your strikes, and that's how you're going to make money. And personally, that's one of the strategies that absolutely blew me away when I started trading options is that you do not need to bet that the stock price is going to go up or down. You can bet that the stock price is going to stay within a certain range, which is really powerful, which is exactly what I do when it comes to earnings. I'm not going to buy calls or buy puts as to try to predict the stock's movement. I'm going to sell short strangles one day before the earning announcement so as to benefit from this IV crush. And I'm betting that the stock price is not going to move too much and is going to stay within my profit zone, and thanks to the help of the IV crush that is going to make option prices drop suddenly just after the earning announcement, I'm hoping to buy back my short strangle at a lower price and so make a profit overall. And I've been doing this over and over for a lot of earning seasons, and really it's a great strategy. There are a lot of things to consider, to think about, and that's why I'm not necessarily telling everything in this video. This is more to give you an introductory video, and if you want to see more details on this strategy and how I actually do it, what are the things that I'm paying attention to, then you can watch my video on how I trade earnings. I really detail all my process in there. I mean, I really gave away everything, so hopefully this is useful for you. If you have any questions, please don't hesitate to comment it below. I'd be happy to answer any question that you can have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.